Imagine waking up one morning and realizing that the greatest genius in the world just got played by a stock scam. That is exactly what happened in 1720, when Sir Isaac Newton, the man who figured out gravity, lost what would be millions of dollars in today's money in Britain's first great stock market scam. And the craziest part is this: the tricks that fooled Newton are still being used today. This is the story of the South Sea Bubble. How a company with almost no real business convinced an entire nation that getting rich was guaranteed, until the whole thing collapsed. Let's rewind to the early 1700s. Britain is powerful, but there is one big problem: debt. Decades of wars have left the government owing around £30 million. A huge number for the time. The interest payments alone are crushing. Politicians are desperate. They need a way to get rid of this debt without raising taxes too much and without starting a revolt. Enter a group of ambitious businessmen and financiers with a simple pitch. Let us take the government's debt, and in return, we'll get a monopoly on trade in the South Seas. We'll turn a national problem into a national profit. This is how the South Sea Company was born in 1711. On paper, it looked brilliant. Investors would hand over their government bonds. In exchange, they would receive shares in this exciting new company. The government gets its messy eye, always converted into something cleaner. The company gets a steady income from the government, plus the right to trade with South America. And ordinary people get a chance to become rich from global trade. There was just one tiny issue. Britain did not really control South America. Spain did. The South Seas sounded exotic and full of treasure, but in reality, the company had almost no real trading opportunities. The business model was less shipping riches across the ocean and more moving paper around London. But people did not see that. They saw what they wanted to see: a story of easy wealth that was officially blessed by the British government. And at the center of it all was John Blunt, a clever, calculating financial operator. Blunt understood one thing very well. If you can get people dreaming of quick riches, you do not need real profits. You just need rising share prices. For a few years, the South Sea Company was quiet. It received interest payments from the government, did a bit of trade, and watched as other early joint stock companies, like the Bank of England, grew in influence. But by 1719 and 1720, things were changing. France had just run a similar experiment with the Mississippi Company, a scheme designed by John Law. French investors went wild for it. At first, the price soared. Everyone seemed to be getting rich. London watched this French bubble from across the channel and thought, "We want one too." The South Sea Company saw its chance. In 1720, it proposed a huge new deal. It would take over almost all of Britain's remaining national debt. In return, it would be allowed to issue even more shares to the public. The company and its allies promised Parliament that this would be a miracle solution. The debt would become manageable, the share price would rise, and everybody would win. Parliament agreed. The deal passed, and the South Sea Company now had exactly what it needed: a legal excuse to print shares and a story to sell them with. Now the real scam began. The company did not just sit back and hope people would buy. It actively engineered a bubble. First, it launched a series of new share issues, many of them on installment plans. Investors did not need the full price up front. They could pay a little now, a little later, and still claim their spot in the golden future. If that sounds like buying meme stocks on margin, that is because it is the same psychology. Buy now, pay later. The price will be higher anyway. Second, the company quietly supported its own share price. It lent money to investors so they could buy more shares. It encouraged the use of shares as collateral for loans. The higher the price went, the easier it became to justify even more lending and even more buying. And third, the South Sea Company used publicity and connections. Members of Parliament were given special access, early deals, and gifts. Rumors were spread about upcoming profits from South American trade. Pamphlets promised huge future dividends. The company wrapped itself in national pride, suggesting that to doubt the South Sea scheme was almost unpatriotic. The result was a mania. In January 1720, South Sea shares traded at around £128. By June, they had hit around 700. By late June and early July, the price neared £1,000. Imagine a blue-chip stock, tied to the government, going up roughly 8 times in 6 months. Coffee houses in London turned into mini stock exchanges. Servants, shopkeepers, and aristocrats all piled in. People mortgaged their homes to buy more shares. Others sold safe assets, like land, to join this new certain path to wealth. And it was not just the South Sea Company. The excitement spilled over into dozens of other wild schemes. Companies sprang up promising everything from turning lead into silver to recovering sunken treasure. Even one famously described as a company for carrying on an undertaking of great advantage, but nobody to know what it is. Investors were so drunk on the idea of fast money that they did not care what they were buying. Even Isaac Newton was caught up in it. At first, he invested early, made a nice profit, and sold. But then, as he watched his friends become insanely rich while he was sitting on the sidelines, he broke his own rules. He went back in, this time with much more money, near the top of the market. When the bubble burst, Newton reportedly lost around £20,000. That would be several million in today's money. Later, he is said to have remarked, "I can calculate the motions of the heavenly bodies, but not the madness of people. So what burst the bubble?" It was not a single event, but a slow realization. By mid-1720, some investors started to wonder if the price could really keep rising forever. Foreign investors began quietly selling. Other speculative schemes were shut down after a new law, the Bubble Act, tried to control unlicensed companies. Ironically, the Bubble Act was supposed to protect investors. In reality, many people read it as the government favoring the South Sea Company over its rivals, which pushed the price even higher for a short time. But gravity always wins. As some large investors took profits, nervous selling began. The South Sea Company tried to support its own stock, but it was like trying to hold back a tidal wave with a bucket. By September 1720, the price was collapsing. From nearly £1,000, it dropped to 200, and below that. By the end of the year, the stock was worth barely a fraction of its peak. Fortunes were destroyed in months. People who had felt like geniuses in June were ruined by Christmas. Banks and goldsmiths who had accepted South Sea shares as collateral were now in trouble. The entire financial system trembled. Anger turned to Parliament. How had this been allowed? Had ministers taken bribes? Had insiders known this was all smoke and mirrors? Investigations revealed an ugly web of corruption. Directors had handed out shares to politicians at favorable terms. Some officials had secretly sold while telling the public to keep buying. The company's finances were tangled, opaque, and full of creative accounting. Punishments followed. Several South Sea directors were stripped of their wealth. Around £2 million of their assets were confiscated to help compensate victims. Some were banned from ever holding public office again. Out of the chaos, one politician rose, Robert Walpole. He stepped in to stabilize the system, restructure the debt, and stop the panic from turning into a total economic collapse. Many historians see this moment as the birth of the modern role of a prime minister in Britain. So what made the South Sea bubble Britain's first great stock market scam, instead of just a normal crash? First, the company sold a dream it knew was unrealistic. It talked up South American trade that it could never truly control. Second, it engineered its own rising price through loans, insider favors, and complex share deals, rather than real business profits. Third, it used political connections and national pride to silence doubt. If you question the scheme, you are questioning the wisdom of Parliament itself. But the most uncomfortable lesson is this. It only worked because people wanted to believe. They wanted their government's problems to magically turn into their personal fortune. They wanted to think that this time was different, that a new financial invention had made risk disappear. Every generation, the technology changes. In the 1720s, it was sailing ships and joint stock companies. In other eras, it is railways, radio, dot-coms, housing derivatives, or crypto tokens. But the pattern is the same. A story of easy wealth. A company or sector that seems blessed by the future. Leverage, loans, and financial engineering pushing prices higher. Insiders cashing out while the crowd piles in. And then, when belief finally breaks, a crash that looks sudden, but was building for months or years. The South Sea bubble did not just destroy savings. It left a psychological scar on Britain. For decades, the public was suspicious of joint stock companies and new financial schemes. The government became more careful about how it handled debt and who it allowed to sell shares to the public. Isaac Newton's loss became a symbol. If even he could be fooled by greed, what chance does everyone else have? But there is another way to read it. Newton's mistake was not that he was stupid. It was that he was human. He let emotion override calculation. And that is the real warning from Britain's first great stock market scam. Whenever you see an investment that everyone suddenly loves, that politicians praise, that your friends are getting rich from on paper, remember 1720. Remember the South Sea Company. And remember that even the greatest mind in history could not escape the gravity of a bubble.